All right, I had a concept today that I think is really interesting that I wanted to share with you. And this is a size versus risk grid when you're analyzing deals or potential opportunities. I got this idea, I added a little bit to it and kind of spruced it up, but I got this concept from the book How to Make a Few Billion Dollars by Brad Jacobs. I just started reading this. It's really interesting. He's had like $7 billion companies or something insane. And shocker, he basically says that M&A is one of the best strategies for rapid growth and building a lot of value. And so probably not surprising, but to me, just underscores the importance of this. But he shared a little bit of this concept. I've added a few elements here and some names for each of these little sections. But he shared this concept of looking at deals in four buckets, basically. So if we look here, you start with the deals that are smaller. And then you have deals that are riskier, right? So you've got sort of small deals, large deals, and then your deals have more risks or deals that have less risk. And that basically breaks out into four quadrants, right? We'll start with the most obvious two, which one is what I call holy grails, right? So these are big deals that don't have a lot of risk. And what Brad says in How to Make a Few Billion Dollars, and I agree with, is these are great if you can find them, but this is what every single person in the market's looking for. And a lot of cases, they're hard to locate, right? So big deals that don't have a lot of risk are great, but very, very challenging to find, right? So then we'll go to the opposite side of the quadrant, which is small deals that have a lot of risk. I call this the pain pit. And part of that's because I've been to the pain pit and done small deals that were a huge pain in the butt. And so the deal's small and it has a bunch of headaches and risks and challenges. It's not worth it, right? Just don't do it. Don't go to the pain pit. The next category we have on here are what I call juicy grapes. So this is my own verbiage here that I'm adding in, but juicy grapes, and I call them that because they're small, but they're not as risky, right? So it's like a grape. It's delicious, but it's tiny. It's not going to satiate you as an entire meal. And the challenge with juicy grapes is that sometimes they can be great deals, but they often don't scale, and it's hard potentially to justify some of the bandwidth commitment. And so candidly, I've got a few juicy grape businesses that I've acquired as well, and they're not bad businesses. In fact, some of my favorite, like probably one of my favorite portfolio companies is what I would consider a juicy grape, in the sense that it's a smaller deal, but it was a really well-run company in a really cool market. And having a few of those in your portfolio isn't a bad thing, but the most interesting opportunities, and there's a big caveat here, the most interesting opportunities are what I call hidden gems, which are bigger deals that have more risk, right? Riskier deals, hairier deals that are larger, with the important major caveat that if the business has problems that are solvable, right? And that's a pretty broad definition, but if the business has problems that are solvable, it can be a hidden gem, right? So bigger, riskier deals. Obviously, if all you could do are large deals that don't have a lot of risk, great. You're going to make a lot of money. Your life's going to be easy. Easier said than done, and one of the most competitive places to play. Bigger deals that have a little bit more risk, if the problem can be solved, right? It's not a structural issue with the market, or it's in some melting ice cube where the business is dying, or it's got some fundamental flaw with the product or whatever, right? There's all kinds of structural problems that you wouldn't want to have that could be a big deal that has hair that's not fixable. But if you have a big deal that has a solvable problem, and that's either you have the relationships, knowledge, expertise, track record, insight, strategy, or approach that could enable you to solve that business's problems in particular, or by buying it, if you're already an existing business owner, by buying it into your business, you can solve some of the structural elements or issues with the business. That's where huge value can get created, because oftentimes you can buy those businesses at a more attractive price, and you're not having to pay for the premium, hey, everything's great. Instead, you're buying something that has a little bit of hair, but there's a solution and a path forward to fixing it or solving it. So these hidden gems are one of the most underappreciated pieces of the market, and an area that I personally like to hunt around in. And what I try to find are a lot of times these hidden gem opportunities. The other thing I wanted to add here or say is size is relative, right? So what I would say is deal size here is all subjective. So it's for you, right? What's a big deal for you? What's a small deal for you, right? It might be a small deal might be 100K. It might be 10 million, depending on the size and scope of what you're looking at and what you're working on. And so there's no definitive numbers here that a small deal is anything that's less than 500K of revenue or 500K of profit or whatever it is. It's all relative to the size of opportunity set that you are looking at. So don't get too caught up in the specific dollar amounts here. It's really more about looking at the market, thinking about opportunity cost, and finding places where you can plug in and find hidden gems and big opportunities. And it's also about staying out of the pain pit. Don't go to the pain pit. So hopefully this is a cool, helpful thought exercise or a way of thinking about doing deals that might give you a little bit of a different insight into the market and a unique approach as you think about deals and opportunities and businesses that you're looking to acquire.